The performance of the S&P 500 year to date is eerily reminiscent of what we saw at the start of 2012. We've got a chart here and take a look. The white line is what happened in 2012. The incomplete yellow line is what we've seen so far this year. If we continue to mimic what happened last year, then prices will head south at the start of May, really head south, and then pick up again at the start of June. So spring break, spring soon, it's all coming together, that weakness in the economy and therefore in the stock market.
Well, you know, I mentioned the deja vu factor here. If you go back and you look in the past few years at May's returns, negative in 2012, negative in 2011, even more negative in 2010, down more than 8% in the month of May.
Right. Well, there's that adage, sell in May and go away. Strategas research partners crunched the numbers and found there is some truth to all of that, because if you go back to 1928, the S&P 500's return between November and April is about a 5% gain on average. From May to October, you could see there, less than that, 1.8%. So this idea of sell in May could actually present a buying opportunity for those who are brave enough to jump in.
I don't buy that it's just seasonals. I mean, clearly there is a seasonal factor here, but what we've seen in the economy has also been a little bit of a pattern, and that is we start the year, it looks like the recovery is here, we take off in the U.S. economy, and then all of a sudden, look what happened with housing data today.
Right. Lower than expectations, right?
Weak data over the last
But that's just, that is one data point.
No, but we've seen it across the board. Disappointing data, given where we thought we were going to be at the start of the year.
And that's certainly been the tone the last couple of weeks as well, this idea that the economic data has surprised on the downside. If you take a look at how stocks are performing today, it certainly reflects that disappointment. We started off higher, and now it looks like we are weaker for the moment. I was looking at Caterpillar shares. We broke the earnings at 7:30 a.m. this morning. The stock initially sold off, but now it is higher on the day. It's been bouncing around quite a bit. The thing is, it cut its full year forecast for sales and profit. That was widely anticipated, and the stock has tumbled 10% so far this year, lagging behind the S&P 500 by almost 20 percentage points. So maybe some of that is already factored in, mainly because of weakness in China and the idea that companies are not spending on mining.
But it just goes back to the overall theme, which is if you look at the best performing industry groups this year, healthcare and utilities. Those are defensive. They're not tied to economic growth. They're not the cyclical stocks like energy, perhaps, and industrials like Caterpillar.
A lot of people make the argument that that's new money coming in to buy those defensive stocks because they want the yield that they offer, the dividend yield. And perhaps the cyclicals are just coming down with that economic data.